reported just a little bit the Case-Shiller Home Price Index for the month of May, and momentum is continuing to build in that housing market. We saw pretty decent year-over-year gains in the pricing, although on a month-to-month basis things slowed a little bit. But first-time home buyers remain a weak spot. For his analysis on the sector and a look at some of the key players, including D.R. Horton, we're joined by Jeff Taylor. He's co-founder and managing partner at Digital Risk. They provide mortgage and risk analytics information to big banks. He's in New York. Good morning. That Case-Shiller, I guess about the index was up a little bit more than 4% year over year. It is a May number, saw a little slight decline month to month. What is the pricing environment for houses in the U.S. looking like right now?
Well, thanks for having me, Francis. You know, I think the big story here is not the month over month. It's that the home existing sales are at the highest since 2007. The U.S. housing market is really stabilized. Now, there's still markets like Miami and San Francisco that you have steep price appreciation because that's more directed at supply and demand. And you still have areas in the Southwest where it's still a little bit flat because some of those foreclosures have not made its way through the system. But overall, the U.S. housing market's really on stable footing.
Jeff, you say that the housing market, there are signs that consistently positive signs that the housing market is improving. What are those signs beyond the pricing metrics?
You know, so the signs right now that you're looking at is like the millennials have not really got back into the housing market yet. Traditionally, we want them, in first-time home buyer, to make up like 40%. They're typically at 30% right now. But a recent survey we did shows that millennials are actually talking about moving out of those apartments that they're renting into the city and moving into the suburbs and buying. And one of the main reasons why is that monthly payment can be 25% less in a lot of major cities. That's a significant savings, and they're building equity.
What about households? So that's the millennials. Generally, how does household formation look like right now? Because I understand we're way behind where in the U.S. where it should be.
It is. I think that's still a story to be told a little bit later on. Again, most of the household formation, again, comes back to that millennial younger group where, and we just went through the financial crisis. So a lot of them are coming out of college, they have a lot of student debt. They're sort of waiting to see what happens with the job market, their career, before they commit to actually get married and then actually start a household. So that's a story that's still developing, and I think will take a little while longer to play out.
What kind of information? I know your company does provide information to the banks and the mortgage industry in the U.S. What kind of information do those entities want to see from you?
Right now, what they're all looking at is everybody remembers 2008. Nobody wants to go there again, but they also realize that in order to expand the credit box, they got to loosen some of the credit policies right now. So how can they do that responsibly, still make a great loan, not maybe the perfect loan, but really start to expand and attract a broader industry to be able to get the mortgages?
The big thing for a lot of people right now is what happens from the Fed. There seems to be a consensus growing that they'll start to raise rates in September. How will you be looking at that?
You know what? I think it's a great thing. It's like the story we've been waiting to tell for 18 months. I think the economy's on the right track, jobs, wages. I think that first rate hike will be a good thing, actually, and we'll get it behind us. And I actually think in the U.S. you might see a little bit of a housing burst for people trying to get into the housing market and buy a house before the second rate hike comes. And also, from a lender perspective, a lot of the banks right now are not really going outside the box to create mortgage products because interest rates are so low. The higher interest rates go, the more yield they'll see in that asset class, the more money they'll put behind it, and again, that will expand the credit opportunities for people across the country.
An interesting or different way to look at that, actually, Jeff. Let's talk about some of the companies, because D.R. Horton, big home builder in the U.S., reported decent numbers, but people were looking for something even better on the order side. Give us some color on that.
So I think D.R. Horton reported really good numbers. Lennar actually is my top pick in the builders in the segment right now. But on the order side, you know, people forget that when the whole housing market shut down in 08, 09, that proverbial conveyor belt stopped, right? So all the supply, whether it be wood, timber, concrete, labor, kind of stopped. Now, as you're really seeing that pick back up, you're looking at the Lowe's, the Home Depots, those stores are really starting to take up, and that conveyor belt is a nice constant running machine again. So I think that's where you're seeing on the order side.
Do you see us getting back to levels that we were at prior to the financial crisis, the peaks in 2006, whether it was on starts or permits or even existing home sales?
Yeah, I know we're really there, right? The existing home sales and new home sales are higher than they were in 2007. So we've already hit that nationally. So I do. And I actually think that we have a lot of room for growth because I'll keep hitting it. And I know we keep talking about it, but boy, that first time home buyer, when they move that needle from 30 to 40%, that's going to move a lot of inventory nationally over the next couple of years. And that's going to be an exciting story. And again, a sign that people really believe in their jobs and they're good with buying a house and really looking at it as a wealth creation mechanism versus just a place to live. And we got to get back to that mentality.
And just out of interest, Jeff, do you ever look north to the housing market here?
You know I do. It's been some nice price appreciation in Canada. I'll look at two cities in particular. Vancouver, the prices have gone up, and I think a lot of it has to deal with the immigration and the constant influx of people. Toronto, again, a lot of it's high rises there, and the pricing has really kind of moved up. I don't see any type of U.S. collapse or any bubble forming there at all. I wouldn't be surprised if prices came back a little bit in Toronto. But what I really like about the Canadian market is most of the loans seem to be a shorter fixed interest rate. That means they're really incentivized to sort of pay those loans off quicker, and that subprime mortgage that really caused the financial crisis really doesn't exist in Canada. So I feel very bullish about the Canadian housing market.
Jeff Taylor, thank you very much for taking the time this morning.
Thank you.
He's founder and managing partner at Digital Risk.